I'm basically just really setting the scene here for the panel this morning. I'm not going to dive too much into individual sectors or so, just some highlights, some recent data, a bit of macroeconomics, a little bit of data from occupier markets and investment markets, and I think that should get this discussion going for the panel. Now, I think at the moment, if you read the headlines and you look around, it doesn't often feel like it. The overall macroeconomic outlook, I think, feels still very volatile, lots of uncertainty around. But I would also say, so far so good. I mean, Germany made it through the winter without rationing gas. That was actually a real fear. And you can really see now how the price of gas has come down significantly, and that should feed through eventually also to consumers. I know oil prices are a little bit elevated. The demand from China is coming back. But overall, you look at other factors like supply chain issues, the pressure is really easing, and that's all good news for the inflation outlook. And you can see sort of how the headline inflation here really comes down. What we also see, though, at the moment is that core inflation is still going up. So if you take, things like energy out of the calculation, you can still see core inflation going up, also because we see sort of wage growth coming through. So when you look at unionized trade agreements, there is definitely wage growth in the systems. And since core inflation is usually a little bit more sticky, you can see that while inflation is coming down, it's probably not going to be as quick as we think. And even the forecasters can't really agree. I have the numbers here from Oxford Economics and from Consensus, and you can see sort of the gap here. If you ask me, I'm a little bit more in camp Consensus, so I think we'll take a little bit longer for inflation to get really out of the system before we go back to sort of more sustainable levels, or before we get closer to the target levels. Now, of course, bringing back inflation is one of the main and overriding targets for the ECB, and has been over the last months. And we've probably seen sort of the steepest rise in interest rates that the ECB has ever delivered in its history. The refi rate is now at 3.5%. And if you just cast your mind back, in June last year, we were still at 0%. So I think that's really sort of amazing to see. What is encouraging, though, is as well, if you sort of follow the ECB announcements, the ECB's own research team or own forecasters have revised their forecasts for inflation down as well. But I do think, there is more to come. I think the ECB will continue to hike rates. They want to really make sure that we're not getting into sort of a wage price spiral. Schroders house view is that we end up at 4% in May, definitely in June. And I think that seems to be sort of consensus if you look around sort of at the forward curves and at swap rates. And of course, the increase in the interest rate has led to a real spike in government bond yields, clearly very important for us as we use that as a risk-free to sort of do our real estate pricing on. Now, the high level of inflation had, of course, a massive impact on businesses and consumers, and you can see the drag here quite nicely when you look at the GDP figures. Will Germany be able to avoid a recession? I mean, some of the numbers suggest that it's just about to do that. But again, with so much uncertainty and volatility in the markets, I think that's not a given. And I think the IMF forecasts that were published a few weeks ago were quite a bit more pessimistic. And I think that gives you again sort of the idea that things are still sort of volatile and uncertain. I mean, the only thing that comforts me a little bit is should we see a recession, I think it will be a fairly mild one, and we should be sort of out of this fairly soon. Let's get a little bit closer then to the real estate markets. The high interest rates and the correction bond yields had, of course, fed through into market pricing, and you can see sort of the decompression for some of the biggest sectors here. The low yielding asset classes and sort of secondary is clearly most affected, and things that you would probably put under the sort of living umbrella seems to be fairly resilient. I mean, it's really interesting to see, when you look at some of the curves here for offices or logistics, offices for prime in the Big Seven. CBRE had that down at 2.5% at the peak, and you are now sort of at 3.75, and logistics is also, back at 4, up from 3. This is really the market pricing as quoted by brokers. So, that's what the brokers tell you. The question really is, and I think that would be an interesting one to be discussed on the panel as well, how much is that and how quickly is that feeding through into actually valuations? Because I think that's really important. I'm really sort of interested to hear the panelists' sort of thoughts about that, because I think it's a sticking point, and I think once you see sort of this pricing happening in the market and feeding through also into valuation, you'll see liquidity coming back. You also can see sort of when you look at the curves a little bit more closely, since the start of the year, we've seen a little bit of a leveling off. So I think we have seen actually, quite a bit of the correction that we should anticipate by now. But as I said earlier, interest rates are still not at a peak, and I think that means that we still have a little bit further to go before we reach sort of the bottom of the market. Interest rates and sort of the availability and the cost of debt is obviously a major factor on how the markets move forward. And I think it's fair then to have a quick word on the banking sector. The collapse of the Silicon Valley Bank and then subsequent banks in the US, the forced merger of Credit Suisse and UBS, clearly sort of triggered a fear sort of in the global banking community that there is a more systematic risk. Again, what gives me comfort is that the regulators and sort of the governments have stepped in quickly to resolve those issues. And I think while I'm pretty sure we will see a little bit more fallout in the US, especially from that sort of like more local or regional banks, I can't see a systematic risk here. And if you look sort of at the credit default swaps here for banks, you probably can't see that, but the different lines basically reflect European banks, US banks, and UK banks. You can see sort of that the market also seems to think that there is not a sort of systematic risk. You can see clearly the spikes, when the collapse of Silicon Valley Bank happened. But overall, the market seems to be fairly calm here. And again, I think most analysts would agree that European banks are deemed as well capitalized. And I think when it comes to the impact on rate hikes, the ECB and the Fed were not concerned. The news from of the collapse of Silicon Valley Bank came out, and days later, the Fed decision and the ECB decision were due, and people were thinking, well, does that have an impact? Will they scale back? Will they hold off from hiking further because they're concerned about the banking sector? They weren't, and it tells me that fighting inflation is still the overriding issue, and that the impact here on future sort of rate decisions is probably quite minor. It has an impact though on our markets. You can clearly see it in the REITs market. Market that is always responding straight away. You can see that the borrowing costs for REITs have gone up, the spreads have increased, but generally the markets are open. For direct real estate, again, I'm not concerned about it, but it's just something that you don't need. It's just not helping at the moment. That I think we see credit conditions tightening a little bit. I think the whole situation could sort of push sort of this refinancing distress a bit higher. And certainly, the definition of what is a prime asset has probably become a little bit tighter at the moment. And if this goes on, then yes, it could push out yields a lot further than we've probably anticipated. The good people at PMA, they run a scenario forecast. So they have their main scenario, and they run a scenario forecast for a banking crisis. And if you think about that, then capital values will fall about 30%. For European real estate, whereas under the main scenario, we're probably looking at 15%, and I'd say 10% of that we've already seen. It's also not helping with the real economy. If credit is tighter, it impacts sort of households and businesses, and in a way, sort of is another drag on households and businesses and future demand for the economy. So, as I said, I'm generally not worried about it. It's just news that we don't need, and that's probably prolonging sort of the recovery of the market a little bit. Well, how do we move on from here? I think values have corrected, and they will correct more, and that, in my opinion, also presents opportunities in the near future, because I think you have much better or much fairer value than we've seen for many years. that's for investors with equity. And I do actually believe that there are a lot of investors out there that are lining up now. You know, they are waiting on the sidelines for the correction sort of to happen once interest rates have reached their peak and sort of the first product comes into the market. There are investors who are happily investing at the new sort of pricing levels. At the moment, of course, there's almost no liquidity in the markets. As you can see, you know, the Q1 transaction volume here from RCA is still preliminary numbers, but you know, even if you go up by another 10% from that, you know, it's one of the weakest quarters we really had in a while. And again, you know, that makes it a little bit difficult also for valuers, because a lot of valuers, you know, make their valuations based on comparables, and if you don't have any market movements, you know, it's quite hard to sort of come up with comparables. What is interesting to see, though, is, you know, that in the real world, sentiment is not great. I give you that. You know, of course, you know, inflation and the outlook for a period of very, very slow growth is clearly not helping. You can see sort of how, especially consumers are still, you know, very, very gloomy, and that will definitely also not help sort of the retail sector. But if you look at employment expectations, they actually remain very high. And yes, you know, we've seen an uptick in business bankruptcies. Some of it may be still corona-related, and some definitely related to the extreme period of inflation. But again, you know, this is not the end of the world. So, you know, if you think about sort of the underlying fundamentals in the real economy, it's actually not looking that bad. And looking at occupier markets again, you know, I think the situation is fairly robust here. Taking the office market as an example, demand has softened a bit at the end of last year, but from, in my opinion, very high levels of activity. And yes, sure, I mean, the next 6 months will not be sort of amazing leasing markets, you know. The economic situation and uncertainty, you know, is not helping decision makers and companies sort of to go for more space. But I don't see big imbalances in the market. You know, you look at the supply side, you know, supply is peaking this year. There's a bit more to come in 2024, but after that, you know, we're going to see sort of office supply really going down in those markets, which is driven, in fact, also by sort of the construction costs we've seen, plus the availability of finance. So it's quite hard, actually, if you want to start a project or if you wanted to over the last 9 months, and you know that'll pay off. So again, if you look at the balances here in terms of the supply side, then you know I'm fairly happy. And you know maybe one word also about the impact of working from home. Because I see all these headlines, you know, in the Financial Times, and it's always sort of, you know, very, very gloomy. People are not coming back to the office, you know, all these office stock is obsolete, and I'm a bit sort of like over that. Because I think it's, you need to distinguish a little bit more. I think high quality offices, you know, is definitely something where people want to be. And in all fairness, a lot of these comments that journalists make about this come basically from the observations in the US. I think the US really has a problem. You know, I think in the US, office occupancy is probably 30–40% down on sort of the pre-pandemic baseline. In Germany, 10%, 15%. I mean, the panel might correct me later on, but I have the feeling, you know, in Germany, people are back in the office. I mean, in a way, or maybe there's a cultural element to it as well. You know, I still believe, you know, that, you know, in terms of management attitude and even employee attitude, you know, it's the office where work happens, where people come together, where they collaborate. You go there, you do your job. Management likes to see you in the office, and that's how it is. And in fairness, you know, many of these big cities, they have sprawling urban areas, but again, you know, commuting in from the outskirts of Hamburg into an office in the CBD is not that much of a journey, and it's definitely sort of a much maybe I'm corrected because I haven't lived in Hamburg for more than 12 years. But you know, I think it's still a more pleasant experience than being on the Northern Line for 20 minutes. So in that respect, you know, I'm less concerned about sort of this whole fear about working from home. Yes, of course, you know, work practices in Germany have adjusted and people are able to work from home a little bit more, and they take advantage of that here and there. It's great, you know, it really helps, I think, with employee satisfaction and you know, like attracting and retaining people. But this problem that, you know, we're going to see empty offices in Germany because, you know, masses of people are working from home, I think that's in my opinion, very, very overrated. And yeah, when we look at the supply going forward as well, what we need is modern offices, and companies understand that. If companies move now, they really see sort of the space as a business tool. It's not just a cost factor where you put some desk in and put people in. They see how it has a value for the brand, how it attracts people, how it helps them with their ESG credentials. It's part of the overall package of what the brand is and what your company is about. And if you look at that kind of space, modern space, good ESG credentials and so on, in central locations, that kind of stuff is not a lot of that around. You look at vacancy rates for grade A in those cities, you look at the different submarkets, sort of city center versus more peripheral, and you can really see how we are in a very, very polarized office markets. And I think that goes sort of for a lot of other asset classes as well. People often sort of like have strong reservations about retail, but even in the retail sector, sure, your high street in a B location or your secondary shopping center, that really has a problem. But a supermarket in a growing urban area, probably quite comfortable with doing that. And yeah, the ESG challenge is even bigger if you think about the journey to net zero and carbon, because the stock we actually have is fairly old. I mean, you don't realize. You see sort of the cranes dotted around the city, and you think, oh, there's lots of construction going on, lots of new buildings. But the truth is, in the majority, the building stock is rather old. And the bright people at JLL did some modeling where they sort of used Munich as an example, and they basically compared the overall future potential demand for this net zero carbon aligned space and sort of the development pipeline. As you can see, sort of this big mismatch, and it's a big challenge for the market. But I think it's also an opportunity. If you're able to supply this kind of space, people will really go for it. I think that's also reflected in sort of the forecast for prime rents. Yeah, for that really good space in these like central locations, occupiers are willing to pay. And for us as investors, that's really good news, because this is your income component, and your capital value sort of course is going to drop because of the changes in your yield, but your income will grow, and I think that gives a little bit more comfort around values as well. So I think as I said at the beginning, so far so good. We're still seeing probably more correction in the market, but liquidity will come back, and I think that will provide lots of opportunities as well. 3 to 6 months, who knows? But again, the occupier fundamentals, are not too bad. Maybe a mild recession. I'm not too worried about Germany.
Great, thanks very much. Let's just start with some brief introductions. Tobias, let's start with you.
Okay. Good morning, everybody. Great to be here. Great to seeing faces in real life again. My name is Tobias Schultheis. I'm founder and owner of Blackbird Real Estate, which is a Königstein-based transaction advisory boutique with additional offices in Frankfurt and Munich. We focus on investment transactions in Germany, but then all over Germany. And for 3 years now, since we are members of SIOR, which is an association of brokers coming from the United States, we also do business in Dublin and the UK. And yes, that's basically it.
Great, thanks. Florian.
Thanks. My name is Florian. I'm chairing the German real estate group of Greenberg Traurig. We are part of the Greenberg Traurig firm, basically in the US, but also here in these nice offices. And I'm pleased to be here.
Great. Marcus.
Yeah, Marcus Beran. I'm representing Berlin Hüb. Been there for 12 years now, in the industry for over 30. Not the first crisis we are living through, so there are concepts for it. Yeah, I basically run a team which takes care of international clients investing into Germany and into the markets where we're present, and we're providing loan and services to those investors.
Great. Rainer.
Good morning. My name is Rainer Nonnengesser. I'm now active for more than 12 years in the PBSA sector in continental Europe. I'm since the beginning of this year with Amro Real Estate Partners. Amro is a specialist integrated developer, investor, operator with a pure focus on BTR here in the UK, and PBSA in continental Europe. Started 4 years ago in Spain. Some 2,500 beds now in the Spanish market established, and we are currently rolling out our expansion program into Germany and the Netherlands.
Great, thanks. And I know we haven't done terribly well with diversity today, including me, but that will balance out over the year, I can promise you. That's just the way it rolled this time. Let's pick up on some of the things that Ollie was talking about there. I mean, just in terms of the market, Tobias, I mean, there's obviously been a pause, but what are you seeing at the moment? And I guess how have you seen that change over the last, let's say, 6 months?
Well, there is a pause, but there's also the will, the interest from the investor side to invest in Germany. But there's still this mismatch between the expectations on the sell side compared to the expectations from the buy side. And I hope I can agree with Ollie when he said in 3 to 6 months we will see deals happening. Because, for example, Frankfurt, which used to be my home turf when I worked for Colliers, in the first quarter there were only 13 institutional-like transactions in 3 months, which is nothing. But talking with people, for example, at MIPIM, they all want to do deals, but the time is not right yet.
And Florian, I guess there's been a lot of talk as well around distress in the market. We were having sessions around finance, for example, before Christmas in Germany, but also then at MIPIM, where there was talk about, we'll expect to see some distress come in, and then some people are saying, well, actually, we're in a different position now. What's your sense of that? Are you beginning to see that coming through? Because obviously there's going to be quite a lot of refinancing, those things coming out.
Yeah, I mean, we see a lot of refinancing need. So far, I think it's mostly that people agree on standstills, and we haven't really seen any foreclosures. But in my sentiment, and that's what I see from clients, this is about to change in certain situations where clients are actually stuck in a development. There is probably a time when banks are going to be tighter, and which will probably provide opportunities. And on the other side, we see lots of clients that are actually waiting to invest, prices to go lower, and in particular, buying platforms or developers.
Okay, interesting. And Marcus, it would be good just to get a sense from your side, particularly looking at the banking and financing side. What are the implications, I guess, for you in terms of lending? And we'll come to what you're seeing in the market in a little bit, but it'd be interesting just to get your sense of what the interest rate rises, the uncertainty mean in terms of your position from the banking side.
Well, there's a lot of elements which came together last year, which basically stopped the music playing at the party. There was not only Russian, there was the interest rate rise, there's the inflation. There are a lot of things which brought the market to a halt. So and that now needs to balance out somehow, and we need to find the right level and prices. And sometimes it's painful, sometimes it's just wait and see. The banking industry has behaved, has learned out of the great financial crisis. The leverages are not significantly high. Even over the years where you had value appreciations, that brought the LTVs of banks generally down. And there is some cushion and room if now values drop, that the LTV levels will not significantly harm the book as it did in other crises. So the big pressure will not be from the banks on that, it will be rather from the equity or mezzanine side.
Okay, and just in terms of does it, obviously it must restrict your lending ability to a certain extent, because obviously valuations change, so therefore on your book, how will that work in terms of, will you then focus more on refinancing what's on your book, or, how does that restrict new lending? What's the position?
Well, the restricting factor also in the past was not so much the loan to value, but the debt yield capability of the income. So it preventing that you run into refinance scenarios where the borrower cannot afford the interest rate. We had certain levels that at exit of a deal, we want to be at 6 or 7% debt yield. So 2 years ago, borrowers claims that why do we ask so high levels at exit compared to the interest rate at the moment in the market? That's crazy. Today we are there, and that's why we said we have still cushion and buffer to do that. Nevertheless, the overall economy, if that goes into recession, the quality of your tenants, with bankruptcy and whatever, might suffer, and that will filter through in quality of loans. And quality of loans means down ratings. You need to have more equity parked, and the equity ratio might, to keep the equity ratio, you might have more risk-weighted assets parked towards your book, and that limits the capability of doing new business. Having said that, if that becomes an element of restriction there, the prices of the loans and how we sell it must go up to retain profitability.
Okay, good. And Rainer, it would be interesting to pick up your, I mean, we'll drill down a little bit into the student side, but just to get your sense, obviously you've been in the market for a long time looking at Germany, but also the comparison with Germany and other European markets. What's your sense of it at the moment in terms of where Germany sits within that kind of pan-European sense?
Yeah. Let me take a little bit of a wider approach than just PBSA. Looking into the living sector in Germany, we have a few trends that come together now, and to be seen whether the outcome will be a positive or negative one. Firstly, looking into developments. Development activities have come to a sudden death in Jan last year when the government pulled the plug on the energy efficiency support programs, all loan facilities provided through KfW Bank. Secondly, then interest rates were rising, construction costs were still on an upward trend due to disruption in delivery chains, plus inflation kicking in from other elements. And this has come to a situation now that you see build applications dropping sharply. Yeah, so the government had, when they started their term, a target of 400,000 new builds per year. They can be lucky if they achieve 200 this year. Building applications show a more southward trend currently. In addition to this, you have a situation that on the existing stock, the biggest threat currently for investors being motivated to do transactions is the discussion on upcoming energy efficiency regulation. We are having a daily discussion on oil and gas heating systems, but this is only the beginning. Looking into what is currently discussed in Brussels on this EU directive on building efficiency, which would target on bringing the energy efficiency level of the existing stock to an F in 2030, which 75% of the existing stock in Germany currently don't comply with. Yeah? And to D in 2035, it's a mission impossible for an investor who would look into a resi portfolio currently with an average build year of 1975. What do I face? Which capex are coming along? Yeah? And how do I price this in? Yeah? And this has a massive downside currently on transactions. This is not limited to Germany, that's a European thing, but I'm pretty sure that the German government will be overactive in bringing this regulation into national law pretty quickly. So we will also be the forerunners in this element. As ever in life, if you have a mismatch between demand and supply, it has an effect on prices, meaning rents. And we have seen rental growth booming already in Q3 and Q4 last year, and this trend is not coming to an end or not flattening in the first quarter of this year. And if I translate that now into my core activity sector in PBSA, most of the providers in Germany and also in the Netherlands, Spain have seen rents rising around 10 to 12% last year. And everybody expects the same effect when the season kicks in autumn this year. So in our niche, we can offset effects on pricing to a certain extent by rental growth. But the overall, let's say, mood on transactions on the investor side, we are also facing and we are also suffering from this. So also the PBSA sector in Germany has not seen any relevant transactions in the last 6 months. And your yield shift figures to me seem more positive than what I currently sense. So we have seen the peak of the market in Q3, Q4 21, where top 7 NOI yields were close to 3%, whereas secondary cities or tier 2 cities were at 3.5%, 3.75%. And there is, I sense a yield shift of 100 basis points currently. Yeah, so I've seen a transaction which has not completed in Berlin recently, where the highest bid was at 4.1% NOI yield, and the seller was looking for 3.8, so it didn't succeed. Yeah, but it gives an indication where this market is currently heading for.
Okay, good. I was interested as well in Ollie's presentation about that sort of split in the market, in essence, between top-rated ESG and the rest, in essence, the demand. Florian, is that something that you're seeing particularly? Is that where a lot of the demand is? And interested to pick up your view as well, Tobias, on that.
I would fully agree on this. I mean, you see top rents going up, and it's really sought after. But if you look to the secondary locations that are not ESG compliant, you start actually speaking of stranded assets. And they need to be refurbished, and it's a bit unclear what actually has to be done. It can be very, very expensive, and it might simply not pay out at the end. So yes, I mean, we see the split, and also, I mean, you mentioned that the occupier side is pretty stable, and I generally agree on this in the good locations. In secondary locations, we see lots of sublettings going on, because in Germany, I mean, leases are pretty long term, between 5 to 15 years. So you don't see the immediate effect on vacancy, but you see the subletting going on. So I think on the long run, it will hurt secondary locations, I'm sure.
And Tobias, what's your take on that?
I agree. Now, it's a couple of weeks ago, I read an article about the investors' position regarding ESG. Are they willing to pay higher prices or to accept higher prices? And the result was that the majority is able to would accept price increases of up to 30% for a fully ESG compliant building, which is a lot, especially in these days when prices go down due to the current market situation. But in addition, and I agree with what you said regarding that when prices go down because we have higher building costs for it, then the rents have to go up. And I can believe that this will be the case in the top 7 or maybe in German B cities, but what about the smaller cities where you have a rental level below 10 euros per square meter? And I don't see space for increasing rents in order to get your building into an ESG compliant building, and this will cause major issues to not professional institutional investors, but to private owners who maybe owned their company, then they sold the business, but kept the real estate and leased it out to local companies. They will become stranded assets, or the risk is very high that they will become stranded assets.
And I guess what's the policy for that? I mean, obviously, then you've got, you're working on transformation loans, and I've seen that more of that kind of focus beginning to come through, especially in the last 6 to 12 months. So in that particular case, Marcus, obviously you're probably not lending on those, those smaller assets. But what happens if something is going to get stranded? How will you then finance that? What's the situation?
Well, first of all, maybe to come back to that, the premiums which are paid for compliant buildings, that will be now the standard, and there will be a discount for every building not be compliant. And the discount is as high as the investment gap will be, and that's what we analyze and what we assess as well. So how much capex needs, and every new transaction which comes in, so what is the ESG story behind it? What do we need to make it compliant? Is it EU taxonomy conform? Is it how much carbon output can you reduce? And for that we have created particular loans. You mentioned the transformation loans, and this war is one in the stock, saying you need to bring the stock down in the consumption. And we created loans to support that, but only for buildings which then have a chance to get a certain certificate, get to a certain level, and those which don't either need to be so cheap that it doesn't, and they're only stranded if that calculation doesn't stack up. So we are prepared. We're looking at it in every transaction. Have also target that our book has a green quota. We are at 30% at the moment with those compliant, and we want to increase that book over the years. And the bank is very committed to that. We issue green bonds since 2015. We had programs for energy efficient programs without any need at that time. There was no ESG mentioned in 2015 when we started those programs, and it plays nicely into our cards because we have everything lined up. And whether you say we do this with a rating or with a certificate, or is the taxonomy from EU kicking in, we just adjust that to the new levels and proceed with that. So, but it's a really big topic, and that's is analyzed more than the pure value side of transactions.
Yeah, and we've seen as well, of course, in the Netherlands, a lot of the regulation is going to be coming through very soon, which is going to then be a real test case, I think, to see how some of these buildings actually react. Because obviously, if you can't let them, where is their value any longer? I mean, it's going to be an interesting thing to track, I think.
The conversion into resi, that's what they do.
There you go, Rainer. Perfect.
Yeah. I think we have seen that 2009, 10, 11, where we had a massive transformation wave from office buildings into resi, especially in the micro living or PBSA sector, as floor plans more allow for smaller units than for multifamily, and I do expect the same to happen in the next 5 years due to all these effects. Yeah.
Okay, so a lot of transformation through into
and I think it's also embedded in, let's say, a philosophy or a political trend. Don't demolish, reposition. No new build. Reuse existing stock. And I think in the light of this, we will also see some programs supporting these trends.
And there's a lot of regulation coming down the track in terms of embodied carbon, especially.
Yeah.
I just wanted to pick up a little bit in terms of, we've seen a lot of capital being raised, particularly Blackstone raising a huge amount last week. What are you seeing, I guess, at the moment in terms of capital on the sidelines or looking to deploy? So who do you think is interested, whether that's that they're going to be entering in the market for Expo Real or whenever it might be? But who do you see there? Is that mainly domestic capital? Is it Asian capital? Is it, so what's anybody seeing there in terms of the interest levels?
We as AMRO are currently in an equity raising process. And if I embed this in, let's say, a trend which comes from last year and is vital also in 23, we see that there is a strong appetite for investments in PBSA in continental Europe. And historically, these are more Anglo-Saxon pockets than domestic pockets who drive these developments and portfolio build-up trends. And if I look back into investor meetings that I have had in the last, let's say, 4 to 6 months, PBSA is a topic where you're not immediately laughed out of the room whilst talking to investors. B, there is a growing number of institutions that have a solid knowledge base and track record in the sector. And they are, especially in the current environment, more than motivated to deepen their activity in the sector by geographical spread, by consolidating portfolios. And I think there is a lot about to happen in this sector in Europe in the next 12 months.
Okay, good. Let's talk a little bit about the sectors as well. Maybe Marcus, I mean, obviously you're sitting on it from not the investor side, but obviously you are investing your finance into it. So I guess, how do you look at the sectors at the moment? Obviously big focus on residential in general in the market, logistics, which has been the case over the last 2 years. I mean, interesting to see, Ollie, that retail wasn't bombing quite as bad. Now that may be comparative, but nonetheless. And a lot of focus, obviously, from the Blackstone raise on other things like, data centers and other areas. But I guess, what are you lending on, and how do you see that? And are there things that you wish you were lending on?
We have not changed the patterns of our lending, and when you say retail has not suffered, but they have suffered through the corona crisis, they were starting from a very low point anyway, so that didn't impact that much. The transformation of offices, yes, is a big theme, and you see the focus on the compliant, the modern office, and the demand is obviously there. And the other part is how to get older stock into that category. That's a big part. And residential, and we are a big residential portfolio lender. We see the big challenges which are out there. If you have a portfolio in North Rhine-Westphalia where tenants are not able to pay more than €5 rent, and you have to invest into that stock, and you cannot always increase prices. People say
Sure.
might, but there's also a limit at a certain point. The question is who's really going to pay for that? If the tenants are not able to, there's a political obligation to do something that knocks on prices and values of that particular stock. So and here that is the transformation of this entire economy, which needs to be somehow realized, and that's where we need to find solutions. At the moment, there is no one way, no plan A to do that in a certain way. That depends a bit on political pressure, on economic pressure, on prices of the energy, and so but it will push us in a direction, and I think everybody will need to chip in at a certain point to really grow out of that.
Okay, good. And sectors for you as well, Tobias. What are you seeing there?
Well, we're currently marketing several business park-like buildings in smaller B and C locations in Germany, like cities like Oldenburg or Nordhorn, Darmstadt. You may never have heard of these cities, but they're strong cities in Germany. And the interesting thing is that we have a strong interest from private buyers. Volumes are somewhere around 5 million per building. And there's a strong interest from private buyer side because they just want to invest into real estate because they think, and that's what all of them say, we want to take advantage of the inflation rate. They pay all equity and try to increase rents as much as they can, of course. So there is an interest, but no deals yet. And also we started, the first one we started selling was in October last year. Back then we started offering at valuation from back then, which was in multiples, 17 times the rent. But I would say prices will be somewhere around 13 to 14 times the rent. So that's the decrease of 15 to 20%. But there's an interest, not institutional type of product, but professional private buyers, I would call them.
Okay, good. And Florian, what are you seeing, I suppose, in terms of interest, people looking at the moment, let's say?
I mean, most people I meet are actually pretty sector agnostic in the moment, but rather say they look for individual opportunities. They're quite certain that will come. I mean, Germany is not the most transparent market compared to US, for example, or UK. So I think it will be very much about opportunity. And in particular, the bigger investors, and I think they will probably come rather from the US and than from Asia in the moment, but that's my feeling. They just look for the opportunity because, I mean, we're probably a little bit at the beginning of a new cycle, and obviously you don't want to be too early but not too late, so that's what you're looking for. And I think they're very interested on the bigger scale deals and platforms for developers.
And logistics still top of mind for a lot of people, or I mean, interesting to see. I mean, feel free to come in on that, Ollie, as well, if you want.
Yeah, I think so, because I think the underlying fundamentals are still there. You see sort of, e-commerce moving forward. You see sort of companies very keen to avoid any further disruptions in supply chains, so they might hold more stock. I think the warehouses you see around, are can be fairly old stock as well. So, there's a need for refurbishment. I do think there is still interest in logistics, especially at those new pricing level. And when it comes to sort of like who's gonna be active, I mean, you look at the UK. The UK is a market that will correct, first. And in terms of, money is around. Well, this is in London. It's global money, but I think there's a lot of interest from the US because there's a lot of investors who had US exposure. Obviously not so happy with that strong dollar. So they look at the UK and they will look at Germany as well. But I also see institutional money coming. But in terms of sectors, logistics, I think logistics has definitely not lost its appeal. And I think pricing levels that CBRE is quoting there 4%. I think at those pricing levels we are much more comfortable sort of with pricing than it was at 3%. I think for many people that felt unnatural.
Okay, good. I had an interesting one. We run the CE Summit in Warsaw each year, and it's coming up again in June and was in June last year. And asking a similar question about how the market was and where to invest. And one of the speakers said, well, I think it's actually probably a better time just to sit on the sofa for a year and catch up on TV. So we're almost getting to that year now. So hopefully there should be some activity coming. I mean, what's your? I mean, Ollie, you were saying that you felt 3 to 6 months there would be more activity coming in. But what's everybody's sense here? I mean, do you see that we're beginning to see the at least there's an idea now of where interest rates are going to settle, and that will then begin to drive transactions. What's your sense of? I mean, we don't have crystal balls, but do we think we'll have a happy time at Expo Real, for example, with a lot more capital looking for opportunities?
Well, we will have a happy time at Expo Real, but
Irrespectively,
But see, last year at Expo Real, everybody said, well, let's wait until MIPIM, and after that, markets will take speed again. At MIPIM, more or less the same people said, let's wait until Expo Real, and market will take speed again. What do we hear at Expo Real? I don't know. I only know that the market will recover. I had this 20 years ago, 15 years ago, and well, the pandemic wasn't really a crisis for me. My personal feeling is that by the end of the year, we will have markets coming back, or investors and then deals coming back, because banks need to make money, and they make better money when they give out new loans, and investors have to spend the equity they were given, and some investors also only earn money when they do deals, and we had that pause. And I think now everybody says, now let's start doing deals.
I think it's interesting you said bank needs to make money. Banks don't make the market. Investors and buyers and sellers make the market. And as long as they don't agree, they sit in the driver's seat and ride shotgun. The bank is only in the back seat. And only if these two agree, then we have a deal. So we're fairly dependent on what the market does. We cannot drive the market as such. Yes, we can provide initiatives. We can provide incentives in these kind of loans, which be transformation loans or whatever, to make that easier, make that happen. But we cannot drive the market and do it. And I think we will go fairly into next year until we see really activity going on. I had a nice comparable once when they said it's like a surfer. We were riding a wave for a very long time, and now the wave is gone. Now we need to settle, paddle out again, and wait for the next wave to come. And that might take up to easily next MIPIM.
And I'm not offending you, but the things I hear about your industry, a lot of the investors I talk to, they say, okay, the interest rate is a given, there's not much one can do, but the LTV, the ratio between equity to debt, that puts a lot of hurt to many investors. When they say 2 years ago, we would maybe even have a debt ratio of 90, 95, 100% of the purchase price. And now it's down to 60%. And that's what a lot of, at least the investors I talk to say, that causes them headache. The amount of equity they have to put into the investments.
Yeah, because you don't want to pay the return an investor has on his equity to the bank. That's why you cannot get a loan high as that. And there was, after financial crisis, a big cry out in the entire societies that no bank should be too big to fail, and that it needs to be bailed out by government money or by taxes. So that's why there are limits, there are regulations to not go beyond a certain limit. And the other risk, which is beyond the 65%, is either mezzanine risk or equity risk. And liquidity is there. It's not that that cannot be covered. And there are other returns being requested. But the banking sector, to stay stable, they have to remain in their turf.
Unfortunately, the person who was going to speak about self-storage today couldn't be here. But I mean, very interesting. Had a long discussion with her about the growth of that market here in, particularly in Germany, but also, we've seen a lot of focus as well, growing focus on the senior living and healthcare side, particularly in Germany, but across Europe as well. And so interesting to see the kind of data centers coming through and those alternatives. And there seems to be a growing focus on that from the capital as well. Very niche sectors still. So we won't drill down too much into those, but I would be interested to pick up specifically on the purpose-built student accommodation. What's happening there in Germany, because it was very different to what was happening in the UK in terms of students being in place during COVID. So has that is that still a growing market? Is there an opportunity there to redevelop existing buildings for that, or is that all new build? What's the position, Rainer?
Yeah, looking into the market fundamentals, you still have a massive imbalance between demand and supply. We have 2.5 million domestic mobiles and internationals. The pure PBSA sector in Germany currently counts for 70,000 beds. Yeah. There are some 200,000 non-profit organization beds by public bodies or by churches and others who bring the so-called coverage rate to the usual 11-12% that you see all over Germany. As a comparison, the UK is at 24% coverage rate, which is also due to the fact that we have a stronger rental residential market than the UK. But the underlying thing is you have massive number of students, you have limited supply. Where does that massive number of students go to? They go into the private residential market, which faces stronger regulation coming up. So for example, in the Netherlands, some of the municipalities, I know it from Rotterdam, they have brought a ruling in place last summer that does not allow anymore 3 or more people to team up for flat sharing, just to protect the multifamily market. Yeah, I would not be surprised if somebody in Germany would come to the same brilliant conclusion and introduce something like that. That would take pressure from rents on the multifamily market, because 3-4 students can pay a way higher rent than a family with 4 people and 1 income. Yeah, but it puts then back the pressure on students where to stay. And in the light of this, there is a strong sentiment for the sector. And for sure there are, as discussed earlier, opportunities coming up for transformations of office buildings. Yeah? And these typically also come along with the opportunity to be in micro locations that are highly attractive. Yeah? And in addition to that, we also see, not as a mainstream, but pretty selective already, opportunities from developers, land bankers that come under pressure from their banks, from their mezzanine providers, yeah, where loans are exceeding market values already, yeah, and there is an ongoing or increasing pressure. And this provides opportunities for people like us who are focusing at building new stock and new portfolios. And this, I think, will be the case until somewhere, let's say 24, until the point where interest rates plus inflation will have, let's say, a more robust outlook than it is today. And would also then allow for interest rates to go further south again. but currently we haven't seen the peak, which is from my point of view, one of the main factors for these uncertainties currently.
But one thing to note, though, is interest rate will come down again, of course, but we're not going to go back to 0%.
No.
I think what we have to realize is that the last 10 years we've seen were not normal.
Yeah.
So what we're going to see is the normal. Some people might call it a new normal, but it's not the new normal. It is the normal, where interest rates are more like, I don't know, I'm making this up now, 1.5%, 2%. That kind of stuff, and that will ultimately sort of like mean that real estate is priced differently as well. I think, Richard, what you pointed at is sort of the difference between sort of a cyclical opportunity and a structural opportunity. I think in a market like this, we will see cyclical opportunities coming up where you basically, enter the market at a low point and try to get out at the peak. What some of the stuff that Rainer was talking about as well, and what you mentioned as well, was things like senior housing and care. These are structural opportunities. Demographics won't change. The demand will just be there and it will just grow. So it is a market that is undersupplied, and that is something you can basically invest through the cycle. Of course, you need to be aware of your finance and the yields you basically get into and so on and so on. But because they are structurally driven by changes in demographics, for example, student accommodation I would put in the same bucket. Those are sectors you can basically invest through the cycle with not too much, but a focus on where's the low point, where's the high point, because you can just see sort of the structural change in demand.
Okay, good. Does anybody have any questions or any thoughts? Yes, go ahead.
Fundamental question seems to be pricing, because at the moment we've been talking, and Ollie and both on Tobias have been saying, well, we've got this price reduction in Germany, but we've been talking about 10 to 15%. But if we just take the basics, say logistics, my sector, you're going from what was 30 times to about 22 times probably. That's a 25% discount or reduction. And then coming to what Ollie's just said, basically we've got the issue that interest rates are not going to go back down. So my question overall is, are German owners basically wrongly waiting for this price readjustment to improve itself again before they'll sell? And it's not going to happen because interest rates aren't going to go back down to where they expect them maybe to go, since over the last 100 years they've been at 5%.
Any other questions, and I'll do them all at the same time? Yep.
Yeah, I don't want to let Marcus get off too lightly. We look at the German market, everybody's waiting for what the banks are eventually doing, right? If you can hold your assets, you will ride the wave for the next 2-3 years, and everybody's waiting for German banks, where everybody says, okay, Germany is a bit delusional, the banks sit on their assets, and other markets, they put more pressure on the sponsors. So my question to you is, obviously you stress test your loans, and they can go up to 6%, etc., but you still have an LTV issue and other issues tying into that. How do you kind of inflict the pressure on your clients at the end of the day for them kind of to fund the gap or to sell the assets? Because you cannot sit on those assets for the next years, even if they're just able to service your loan. Whereas in the UK, I think that pressure is being exercised much faster, and that's why sales start. And the big PE funds, they don't look for distress at the moment. They don't want to buy crappy assets or secondary assets. They just sit there and say, we wait for the core assets and wait for the funding gap to fund that. So how is that going to pan out in Germany with the banks?
Yeah.
Okay, hold that thought, Marcus. Merci.
Well, I need to make notes then.
Thank you. I've got a couple of questions unrelated. You say that the occupied demand is good and working from home is a little bit overdone. I'm curious to see if you're seeing demand, however, going down in terms of space requirement. Because I do think we're seeing that in the UK, and I'd like to understand how that looks in Germany. And a completely unrelated question for Rainer. My understanding of the PBSA sector in the UK is somewhat driven by international investors, somewhat being a big understatement. How big is that market outside of the UK, and how much of that rental growth will depend on that international student body? Because in the UK, I'm shocked at how expensive student accommodation is, and I don't understand how this rental growth is going to be. Who's going to pay for this rental growth? I'm just curious how that pans out.
That'll be me, sadly, Messi. I think it's going to be next year. That'll be me.
And me.
And now kids are doing masters, so suddenly it's really become
Okay.
Are the investors who sit on this 5% or whatever is the delusional? So what else do they do with the money? Why shall they sell if there's no other opportunity? As long as they cash out and have a return, why shall they sell them? If there's no other opportunity, then I'd rather sit and have it. Are banks forcing their clients? We don't sit on assets, we sit on loans. The assets are with the investors. So they need to make up their idea how their capital structure shall be. And if the banking price or the loan price goes up, they need to somehow adjust if further equity is there, if they partner up, if they sell, or whatever. We can only force once a loan is in default or becomes a defaulted loan. And to prevent that, we have taken structures over the past years to say, the past years, whatever, to say at which risk at exit we want to be. That's how I came to the 6%, which was the all-time average. 6-7% interest rate was normal, so that's why that yield sits at that level. As I said, there's no way to enforce that in a way. It's just restructure it and see whether there's a transaction to be done.
I think one issue is
why is UK faster or the US? Because you don't have 10 years interest rates. So there are people who locked in 5 years ago at a low interest rate of 2%, and they sit another 5 years on those loans. So why shall they act now? So as long as that stays out, and then they have rental growth or correction and whatever over the time, you have a different way to look at it once this loan expires. And we did a lot of 10-year loans 5 years ago, where I said usually you have every 5 years rolling. We do the business of 5 years already today, which today is not rolling, which is not maturing for good, and that gives also stability in the market. And here some of the initiatives out of the EU are not helpful because they argue against this long-term commitments which give stability to the market, and that's why Germany is was always kind of boring in a time, because you have that stabilization factor in there.
Good. Any other views, particularly on the pricing side, or on Mati's point there around occupiers?
I was just going to bring it back to the valuers. I think one thing that strikes me is that you look at the UK and it's mark-to-market valuations, and that happens really quickly. Plus you have sort of some of the bigger funds here that actually saw redemptions, and they had to basically sell to create liquidity for the funds, and that put pricing points into the market, and that sort of made the market move. I think that's something we don't have a lot in Germany. I mean, the valuers don't have anything, they don't have comparables, so they sit there and go like, well, I can't really, decrease the value because I don't really I need to justify it somehow. And without anything happening in the market, they can't do that. Where I think, you see those yields from the brokers, and I don't think so. I think some of these valuers, don't take them as serious or as sort of informative as they should be. Right. But I think once they get into it, and once the valuer knocks down the value of the building, the investor holding that asset, will sort of start thinking a lot more about his portfolio and what to do with individual assets.
And also, in addition to what you said, in the UK, valuers valuation is based on what many professionals decided that's how valuations should look like. In Germany, as always, we have a law that defines
Correct.
Valuations, and this law focuses on sustainable rents, not market rents, but sustainable rents. And that's, you ask if they are wrongly waiting for the prices going up again. No, they just say, the valuer says, this is my value, so why should I react when the market says, I'll pay you 20% less? From a German perspective, there's no need, because value is fine, so I don't need to do anything. And
I've similar discussions with our in-house valuers against those who said, mark to market, yes, comparables, yes, this is the outside world. The inside world of a bank says, we make values, the market makes prices. And there's the more you are in an environment where the market is hot, the more you have a gap. And we discuss always with ours, look, they pay X amount, why your value is 10% below that? Because I think that's where the value is. And based on that, we structure our loans, and there's another buffer of comfort which we have in there, that we did not take the market prices as our values into the books.
We didn't pick up on the
International
there's one
students.
specifically for you, but there was also around the occupier demand side, particularly for office. So interested to get a sense of, I mean, Ollie, you mentioned there that the US is seeing very poor times with that, which is definitely the case. And I've noticed JP Morgan saying that they will now want everybody back in the office, including on a Friday, for example. But my understanding of the German market was that it wasn't, it didn't change in quite the same way. But what's the sense of that? And are people beginning to look at less space potentially, or what's the situation?
Well, it's just what I hear is it probably depends on what people do. I mean, we as a law firm in Germany, we're almost 100% in the office, or 90% in the office. But I think in the IT sector, startups, banking sector, maybe insurance. I think obviously, I mean, they would be stupid not to optimize their space.
But optimization is not reducing necessarily, because we're building our new headquarters at the moment. We had our entire staff question saying, do you want your own desk? And pre-pandemic, everyone said yes. We had a desk ratio 1-to-1. After home office, after these kind of studies, we did the same question again, and we're down to 0.8, 0.7 in certain sectors. Do we need less space? No, but we need different space, more community, more communication area. Because as long as you sit according to your division or to your organization, you don't sit together like your communication. So you need to bring deal teams together to have room to have the creativity and to tackle a topic differently than you did before, just separately going through and send the paper to the next will be worked off. Now we sit together and work the problem in a different way. And then you need different spaces, different answers to that. And that needs different solutions. So we need the same space but different uses.
There might be difference between head offices and back offices, where probably you see more home office. And personal experience, the more people commute, the more they're working from home.
Yeah.
I mean, pretty simple sometimes.
When talking about working from home office, I never heard a definition. What does home mean? I have the luxury that I live in a house with enough of space. But young professionals who work in Frankfurt, Munich, Berlin, they may only have a single room apartment where they don't have they have a table where they eat on, where they work on, which is next to the bed. So, and my wife, she was team leader of 15 people, all young professionals, and they all got sick when they did homeworking because this apartment is not prepared for doing homework. Their life was based on wake up in the morning, dress, take your first coffee on the way to work, and then their social life is in the office. And that's, to my understanding, one of the major drivers why a lot of people want to go back to the office.
Okay, good. And Rainer, there was the point as well around PBSA, particularly in the UK versus Germany.
International students, yeah. If you look into the German market, as mentioned earlier, we have some of these 2.4 million who seek accommodation. The vast majority is domestics. We have in Germany a total of internationals. What does international means? For sure, that are the typical Chinese and Malay and Indians. But there is, since 8-9 years, a massive EU internal traffic caused by Erasmus programs. Yeah? And Germany has a very strong rental resi market, which provides alternatives, at least for those who stay longer. Less for an Erasmus student who is on a 4, 5, 6 month term, but somebody who comes from abroad to take full studies, at least to bachelor, they can go to the private resi rental market, which leads to the fact that if you look at PBSA rents in Germany, On average, I would say there are somewhere around 600 euros all in, from a range, let's say something like 300 in Eastern German cities like Magdeburg or Rostock, up to 1,000 in Munich. If you compare this, for example, to the Spanish market, where the rental sector is way smaller, Madrid, nothing below 1,000. Barcelona, nothing below 1,000. Vast majority at 1,300 euros per month. Yeah? If you go into the UK, I think you have also a very strong differentiation here between London and the rest. Where London is on a weekly basis, where we are in Germany on a monthly basis, yeah? And where you are heavily relying on international, true internationals. Yeah? And you have also seen dips here since Brexit, when EU students were brought to full tuition level, yeah? Which led to some deviation into other European centers. Yeah? And if you look into the Chinese, how they are building up their higher education system domestically, there might be a scenario that in 10 years from now, this flow into Europe and also into the US might look completely different than it does today, and not because people change their mind, maybe they will be forced by government policy to stay domestic. And this is something you also need to take into consideration. What is your tenancy structure? Where are they coming from? And how heavily are your rental levels relying on this structure, or how sustainable are these when considering investing in the sector?
Okay, good. I want to make sure we finish on time so that there's time for networking, and you can also then ask private questions. Speakers will all be here. But very quickly, just 30 seconds each, where's the biggest opportunity that you're seeing? Can be a city, can be a sector, can be a strategy, could be opportunistic into ESG transformation, could be whatever it could be. Tobias, let's start with you.
I had a couple of talks with private equity companies, with companies who buy companies, and they struggle with the thing, they can buy the operations, but they don't want to have the real estate, and they are all interested in doing sale and leasebacks. And I currently think of buying these properties as long as the covenant of the tenant is good, and I would go to any city in Germany or in any region in Germany as long as the covenant is good.
Okay, good. Florian.
Okay. Personally, I believe more in Hamburg, Munich, Berlin than Frankfurt, for example, but there might be opportunities everywhere. And I think there will be opportunities. And I think it's a timing issue, as actually mentioned in the back, and probably also the most difficult thing to do. But yes, I think there will be opportunities.
Okay, good. Marcus.
I have much sympathy for the Polish guy you mentioned earlier. Just sit and wait till the dust settles, and then start again.
Okay, good. Rainer.
I'm a strong believer and fan of concept-based living concepts, which are student, micro-living or young professional living, but also senior living products. And due to the massive opportunities that most continental European countries, including Germany, provide in this sector, I'm very much focused on that.
Great, good. We can actually clap hands.